How do you decide what to invest in? The most important factor is around your time frame. So if you've got a really long time frame, like 30 years with our super, we're going to want a lot in US, Aussie shares, international shares, and property managed funds, because they're all the highest performing asset classes over the long term. And if we have some dips, we don't really care because we're making contributions through all those periods as well. So we're actually buying on sale is a way to kind of look at it. Now, what happens if your time frame was really short? So as an example, my clients who are about to retire or already retired, or an example for you might be you want to buy a house, but in kind of 3 years. Well, you don't necessarily want all your money in shares if you're going to buy in 3 years, because what happens if it's these 3 years of the GFC and you've got to wait for it, 3 or 4 years for it to bounce back? So yeah, you would be unlucky, but you don't necessarily want it all in that. So that's why if your time frame is only 3 years, you might have a more balanced mix where you've got bonds, which are the safer kind of dark blue lines, and more cash as well. Okay? But by the same token, you don't want to be too conservative, aka in cash, which is that grey line, because that's kind of just tracking inflation, a little bit higher than inflation. So time frame is pretty much everything in investing. So talking about investing, here is the last 30 years of data, okay? So it's showing what $10,000 would have done invested in the different asset classes all the way through. So the top performing asset class has been US shares, which have averaged 10.8% per year. Now, it doesn't get 10.8% every year. That would be amazing. It bounces around, obviously, but the long-term average is that. So you might say, Michael, yep, just put me in US shares, 100%, you beauty, which would be a fair thing to say, right? But what we also need to consider is diversification. Because if we look at the global financial crisis in 2008, 2009, and this aqua line, look at how low US shares had got. They were even below cash, like savings, for the first 15 years of that graph, okay? So it's important to have a mix, and you probably already would even without you noticing. So for instance, in your superannuation, your super fund's going to give you a mix of each of these inside that typically, they'll call it a high growth or a balanced fund, depending on what you have.